Evergrande, one of the largest Chinese real estate developers, is in massive trouble. China warns that Evergrande won't be making interest payments soon. All markets are down. Is this seriously the start of the worldwide economic bubble popping, which will ripple through all asset classes and finally prove that Michael Burry and the rest of the bears are right? Hello, Andrew here, and in this episode we're going to talk about the Evergrande situation, what you need to know, and how I'm treating it going forward. And if you're in a rush and you don't have time to stick around, I'll both confirm your fears and ease your mind by saying, while yes, it's a big deal, the sun will rise tomorrow and everything will be okay in the long term. As far as what Evergrande is as a company and what they actually do, they're one of the largest real estate development companies in all of China. They're also one of the largest employers in China, both directly and indirectly when including contractors. They do quite a bit of real estate development and have actually done projects over 170 different cities in China. They're responsible for the development of bridges, high-rise buildings, and even the development of entire communities. So in China, they're kind of a big deal. Real estate in China is actually one of the largest drivers of its economy, and it's one of the primary means that a civilian can actually invest in the country of China. They are also involved in a lot of other areas in the economy which may seem too good to be true, including they operate their own theme parks, they have their own media company, they even are into healthcare by owning a couple of hospitals, and it looks like in their single biggest money grab of all, they decided in 2019 to start getting involved in EVs. Nicola. I mean, honestly, the more I look into this company, I feel like I'm watching a commercial where Mickey Mouse and Trevor Milton are driving an electric ambulance to my house and gonna pitch me to change to a blood pressure medication that's different so that way they can save me from a heart attack. So now that we've got a little bit of introduction into Evergrande, let's talk about what we physically need to know. Basically, the company has over $300 billion in liabilities, and it looks like they're not going to be able to pay a large portion of that back. And in case you missed it, I said billion with a B, not million, 300 billion. As a real estate development company, they use a lot of debt financing. So to simplify, they basically over-leverage themselves and can't pay back the money. I wonder what that sounds like. Lehman Brothers. As if over-leveraging wasn't bad enough, one of the other tactics they've been doing is planning to develop areas in China and then gathering investors to sell those properties that they are going to develop in China and charging them a half 50% cost up front before they even start the work. And it looks like there's a lot of projects that aren't even going to get started. So there's a lot of investors who domestically are going to be losing out on money. The other thing that we need to talk about is not just what this default means in the country of China, but as an American, what does this mean internationally? There are many international investment funds, pension funds, and retirement funds which hold assets with Evergrande in the form of their stock. And as YouTubers like Tom Nash and Patrick Boyle have explained before, often when you buy stock in these type of companies, you're really buying stock in a shell company, which means you don't have any claim to any real assets at the home company. As if that wasn't bad enough, there's a lot of hypotheses running around that we have major banks in America and abroad that have financial exposure with the debt for Evergrande. So the fear is if Evergrande goes down, aka isn't bailed out by the Chinese government as one of those companies that's too big to fail. Lehman Brothers. Bear Stearns. The ripple effect could actually cover the entire world. At this time, China isn't indicating that they actually want to bail out Evergrande. And even if they do, it could be a situation where foreign investors are left holding empty bags, and there's nothing they can do about it. This in turn could be the pin that's going to pop the bubble that Michael Burry and the rest of the bears have been arguing. Basically, we could be in the mood for bad news bears coming. So now the part you've all been waiting for. What are my thoughts on the subject and what am I physically doing? As a reminder, I'm not a financial advisor and I'm definitely not your fiduciary. So please don't just blindly follow the advice of a handsome man in a blue shirt that you're watching on YouTube. The first thing to consider is that this is actually a new story and it's going to take time to develop, much like COVID and the 2008 crisis before it did. This means that if it turns out to be a large impact, it probably won't be a flash crash, which means we have time to prepare and we have time to plan. Let's consider COVID-19's timeline. As a Tesla investor, I became aware of COVID-19 when the Shanghai plant was shut down in February when China had 180 million people on lockdown. The stock market, as forward-looking as it is, finally figured out that COVID-19 might impact global supply chains by about mid-February. All the way from mid-February to early March, I still had people telling me that COVID-19 was a farce, it wasn't no worse than the flu, and nothing was going to change in life as we knew it. Fast forward to the week before my birthday, on March 13th, we started to get our lockdowns here in Ohio. This is where I see that we really had the beginning of our major impact on COVID domestically. Then a week later, on my birthday, I got to sit at home and scoop up a bunch of deals in the stock market at bargain basement prices. What this means is, even though a situation is important, it doesn't mean you have to act rashly to take it seriously. Think of being in a crowded building when a fire occurs. It's better to maintain your composure and act orderly moving toward the exit than for a mob to mad rush the exit and everybody to trample over each other. I also am making certain that I reaffirm my position as a long-term investor. I'm doing this because it's important to keep control of your emotions. No matter what happens, the sun is going to rise tomorrow. The world will move on and things will be okay. During times like this, though, we can move to peak fear. And the reason it's important to keep your emotions in control is during peak fear, that's when you find peak opportunity. Since I choose individual stocks, I'm going company by company to ensure I understand how those areas and how my companies will be affected. And any company that I have that is involved with finance or banking, I'm taking an extra hard look to find out if there's a relationship between that banking company and Evergrande. It's very important to determine that up front and know what the risk is. The next thing I'm doing is I'm doing the same thing I did before the COVID crash. And that is I'm looking at my budget and I'm seeing where I can squeeze blood from a bone. If I can pull out an extra dollar and it can be ready on the side for investment because of a possible fear dip, then I'm going to be ready for that. Because this is the moment that you can take during this period of time, the calm before the storm, that you can figure out where you can pull that extra $25 a week. And you'll be surprised if we actually do get a correction, how happy you'll be after you've done that work. It will make the world of difference for the future. The next thing that I'm doing is I'm evaluating my margin positions and I'm starting to reduce them aggressively. And in those positions which I'm not reducing margin, I'm making plans as to what I will do and when I will do it. The idea being I want to be prepared if things go south. The last thing I want to be is forced to make a decision. I would rather make a decision on my terms. The more often I can do that, the more control I can have over my portfolio. The next thing I'm doing is I'm trying to build my war chest to about 25% liquid cash. I'm doing this by taking a look at price targets for stocks that I already own and seeing if any of them have hit early. If they have, I understand that every reaction in a market is an overreaction, so just because it's at the price target now doesn't mean I can't buy it again a little bit later back on the dip. So I would rather have some extra cash as opposed to letting it sit there and not collect any additional premium. The next thing that I'm doing is in those accounts that I'm actually purchasing index funds, is I take that extra cash and I created a plan so that way I wouldn't invest it all at one time. The idea being, if we are going to get a major correction, then every 5 to 10% that the index goes down, I'm going to take of my 25%, a slice of 5% of that and put that money to work. And then as it goes down over and over and over for the period of a couple weeks, I'll cost average down. So that way I don't have all my eggs in one basket on the very first red day. I can consistently buy over and over and over and continue to feel like I'm getting deals. In addition, since I pick individual stocks, I'm going through all of my highest conviction stocks and I'm setting price targets of what would be the goal that I could purchase the stock again at. What would be my preferred price? If it dips down so low, this is the price I want to purchase it at. And I'm setting that up so I have it in front of me in the event that this actually happens. Don't be afraid to put in an order that's good till canceled over the course of the next 90 days because some of these things, individual stocks, can move quite fast. And you don't want to miss out on an opportunity to pick up a 20% discount in the event this story becomes a really big deal. Next, because I invest in real estate, I'm going to take my portfolio, I'm going to go back to the bank, and I'm going to see if I can get any better deals, and then specifically on fixed rate mortgages. If you're going to enter a period where there is going to be a downturn that is going to ripple across the entire world, you want to make certain you're not carrying variable rate mortgages. That's going to be a big deal. In addition to that, you also want to make certain that you've got money available to take advantage of opportunities. So if you have capital, and I do have some capital locked up into real estate, I'm going to attempt to pull that out now at fixed rates while the getting's good. And because I keep some of my portfolio in crypto, I'm preparing myself for a very wild ride. And I'm also consolidating down into my highest convictions. This is important again because crypto is one of those things that can go way up and way down. You can see a 70% drop in a very short time span if you go ahead and look at Bitcoin's past. That doesn't mean it's going to happen again, but mentally, if you believe in it, you need to be prepared for it because if you're not, you're just going to sell at the bottom. And that's not where Bitcoin's going or Ethereum's going in the long term. If anything, you want to have the reserves ready to go ahead and to buy the dip. And no, we haven't seen the dip yet. Well, that about wraps up today's episode. What I want to know, though, is how you feel about the Evergrande situation. Tell me about it down in the comments below. And while you're down there, if you haven't done so already, hit that thumbs up button, click that subscribe button, and consider sharing this with one of your friends and family. It really does help out the channel. And thanks for joining me today. Here on the channel, we produce videos twice every single week. And until next time, I'm Andrew Sherman. This is the Dad Manual. And remember, failure isn't bad. Failure to try and learn is. Have a good one.